The Nano Dimension stock has been the topic of many conversations, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, you should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Nano Dimension has been continuing to have a significant sell-off pressure in its equity shares in the open market during July, as the market continues to be challenging for tech stocks in general, despite the recent spike in Palantir's share price following a decrease in the federal bond yields. We can see that as a result of this news, Nano Dimension saw its stock increasing its value in somewhat of a marginal manner, and that so far, those external factors have yet to push its share price back to the $3 or $4 level in any sustained manner. I would say that the pertinence of Nano Dimension is clearly present. The company is an expert in small-scale manufacturing with automated chains, which should act as a potential catalyst for its share price. With that being said, the current reality seems to be quite different, as the long grind to ever lower price has been going on for far more than a year, and that so far there has never been any sustained signal that this will stop. I think that Nano Dimension needs to demonstrate to the market that it has the capacity to generate profit and positive cash flows from its own operations, and until then, we will continue to see sustained selling pressure on its share price. It's been widely commented that Nano Dimension initially became popular because ARK invested into it, and this is why retail investors picked up the pace. I think that those days when everything touched by ARK turns into gold are now behind us, and that many companies are now on their own, and frankly, I think that Nano Dimension should be one of those. Now, let's take a look at the technicals of the stock. The trading volume of Nano Dimension has recently been 3.5 million shares, compared to an average volume of 2.7 million shares. Over the previous 52-week period, the price fluctuated between $2.17 and $7.93. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a good idea about the popularity of the company. When we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current volume is lower than the average, this is an interesting indication because it may signify that a trend reversal could happen soon. The market cap of Nano Dimension is currently at $852 million versus an enterprise value of $437 million. To put simply, the market cap is the fair market value the company has based on the current market sentiment, the reputation of the company, and other macroeconomic factors, whereas the enterprise value is usually the cost of the company that has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles. So they are essentially the guarantees that a company can grow in the future, because they are the branding, the intellectual properties, and schematics for new products. For startups, most of their valuations are based on those intangibles, which could have been valued in more favorable market conditions. What this means in real is that there can be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below its book value, and it doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place and that it has deflated back ever since. As we compare the current price to its historical price fluctuations, the stock is 22% higher than the 1-month low, 52% higher than the 12-week low, and 52% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment, the implied volatility is 61% versus a historical volatility of 53%. The put-call volume ratio is currently around 0.35. It is normal for most stocks to tend to have a higher put option volume than what they truly deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 6.7 thousand contracts a day versus the 30-day average of 5.3 thousand. In terms of open interest, the most recent volume of open interest has been 269,000 contracts versus the 30-day average of 272,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you the premiums, with an obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put option, then there could be uptrends on the move. Or that the reversal could happen if there's a lot of call options. The reasoning behind that theory is that most options would end up expiring worthless. Regarding the shareholder structure, institutional shareholders own about 30% of its outstanding shares. The biggest shareholders include ARK Invest, BlackRock, and State Street. It's relevant to understand the shareholder composition of a company, as this helps to determine whether you should hold the stock long term or to view it as a trade opportunity. If the trade is mainly held by retail traders, this could be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. Obviously, there's a lot of exceptions to this, since many great companies are also held mostly by retail, but that tends to be the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there's significant short interest in the total volume, this can be a sign that there's an organized shorting operation going on, like what happened with GameStop and AMC. The current short interest is about 9% of the total float, with 51% of the transactions coming out from the dark pools. Usually, if the short interest is above 15%, then there's a real possibility that institutional positions have been taken to short the stock, and that there would be potentials for short squeeze. That's not the case right now with Nndm. My recommendation is to keep an eye on Nndm as a potential equity with contrary effect to VIX and federal bond rate, and to start buying it when the flow of capital starts to favor the tech stocks once again. Alternatively, in the meantime, a strategy of lower dollar average can also be used. I would recommend to commit between 0.5 and 1% of your portfolio, and would also recommend to split this allocation in batches of 10 to 20% at a time, so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.